If you run an LLC or an S-Corp, there is a very real chance you are paying more in taxes than the law requires. Not because you're careless or dishonest, but because no one ever explained how the system actually works. The tax code is not written to punish business owners. It's written to reward them for taking risk, creating jobs, and contributing to the economy. Historically, governments have always used tax incentives to guide economic behavior, and modern business deductions are simply the latest version of that long tradition. In this video, you are going to learn the most common and most powerful write-offs used by LLCs and S-Corp, all grounded in IRS-recognized categories that millions of businesses already use every year. This is not about stretching the rules. It's about understanding them well enough to stop leaving money on the table. Why business income is taxed differently than personal income. Before getting into specific write-offs, it is important to understand why LLCs and S-Corp enjoy such flexibility. The IRS allows businesses to deduct ordinary and necessary expenses incurred in the pursuit of profit. That single phrase has shaped business taxation for over a century. If an expense is common in your industry and helpful to running your business, it likely qualifies. This is why business owners can legally reduce taxable income in ways employees cannot. The goal is to tax net profit, not gross revenue, and that distinction makes all the difference. Why home office expenses remain one of the most misunderstood deductions. One of the most popular write-offs for small business owners is the home office deduction, yet it is also one of the most feared. When used correctly, it is both legal and defensible. If you regularly and exclusively use a portion of your home for business, you may deduct a percentage of rent or mortgage interest, utilities, insurance, and maintenance. For example, an LLC owner using one room in a 10-room house may deduct roughly 10% of qualifying household expenses. The key is consistency and documentation, not size. How vehicle expenses become a major tax shelter when tracked properly. Business vehicles represent another significant deduction category backed by extensive IRS data. Whether you use the standard mileage method or actual expenses, the result can be substantial tax savings. An S-Corp owner who drives to client meetings, job sites, or supplier locations can deduct miles driven for business purposes. Proper logging is essential. A simple habit of recording miles at the start and end of each workday can turn everyday driving into a meaningful reduction in taxable income. Why salaries, payroll taxes, and benefits reduce business profits legally. For S-Corp especially, owner compensation plays a major role in tax planning. Paying reasonable salaries allows the business to deduct wages and payroll taxes as operating expenses. In addition, benefits such as health insurance and retirement contributions may be deductible to the business while providing tax advantages to the owner. Historically, governments have encouraged employment through wage deductions, and this principle still applies today. Professional services quietly absorb thousands in taxable income, often going unnoticed. Legal fees, accounting services, bookkeeping, and consulting costs are among the most commonly claimed deductions for LLCs and S-Corp. These expenses, are clearly considered ordinary and necessary by the IRS. For instance, hiring a CPA to prepare tax filings or a lawyer to review contracts not only strengthens the business, but also directly reduces taxable profit. Smart owners view professional fees as both protection and tax strategy. Now, advertising and marketing expenses are fully deductible investments as well. Marketing has always been central to commerce, and the tax code reflects that reality. Advertising costs such as website development, online ads, branding, and promotional materials are fully deductible. So, an LLC investing in a new website or paid digital campaigns can deduct those costs in the same year they are incurred. This, in turn, effectively lowers the real cost of growth by sharing it with the tax system. Equipment and software purchases can really accelerate your deductions. Purchasing equipment, tools, computers, and software opens the door to accelerated depreciation and expensing. Under current IRS rules, many business assets can be written off in the year they are placed into service. For example, an S-Corp purchasing office computers or industry-specific tools may deduct most or all of the cost immediately, rather than spreading it over several years. This turns capital investment into immediate tax relief. Education and training expenses also qualify as business deductions. Training that maintains or improves skills related to your business is generally deductible. This includes courses, certifications, workshops, and even industry subscriptions. A business owner attending a paid seminar or purchasing specialized training materials can deduct those expenses as part of operating costs. This reflects a long-standing recognition that skilled businesses strengthen the economy. Now, travel and meals become deductible when tied to business purpose. Business travel remains a powerful write-off when properly documented. Flights, hotels, transportation, and a portion of meals may be deducted when the primary purpose of the trip is business. An LLC owner attending a conference or meeting clients in another city can offset a large portion of those costs. The rule is simple. The business purpose must be clear and provable. Rent and utilities reduce taxable income dollar for dollar. Office rent, co-working space fees, utilities and internet services are all standard deductions for LLCs and S-Corp. These expenses directly support operations and therefore reduce taxable profit. Even partial use, such as shared spaces or hybrid offices, may qualify when properly allocated. Insurance premiums quietly protect and reduce taxes as well. Business insurance premiums, including liability, professional and property coverage, are fully deductible. These expenses are not optional in many industries and are explicitly recognized by the IRS as necessary costs of doing business. Now, retirement contributions create long-term tax efficiency. Contributions to retirement plans such as SEP IRAs or solo 401ks can be deducted by the business while building long-term wealth for the owner. This strategy reduces current tax liability while securing future financial stability, a principle deeply rooted in tax policy. And record-keeping is the difference between deductions and penalties. Every legitimate deduction depends on documentation. Receipts, logs, and clear records turn expenses into defensible write-offs. History shows that the IRS penalizes poor record-keeping more than aggressive but legitimate deductions. Understanding business write-offs is not about gaming the system. It's about, using the system as it was intended. When business owners master these principles, they gain control over their finances and stop donating unnecessary dollars to taxes. If this breakdown helped clarify how LLCs and S-Corp legally reduce taxes, subscribe to the channel and share this video with someone running a business. Knowledge compounds just like money, And this is how serious investors stay ahead.